Hello dear students, in today's video session we shall take up session 3 of chapter Issue of Shares of class 12th Accountancy, Company Accounts, Issue of Shares, session 3. Topics that will be covered in today's session are Issue of Shares for consideration other than cash, concept of call-in arrears and call-in advance and their accounting treatment, concept of oversubscription and undersubscription and their accounting treatment. After learning this session, you will be able to explain the accounting treatment of shares in consideration other than cash, pass the entries of call-in arrears and call-in advance, identify the cases of oversubscription and undersubscription. In the last session, we have covered some basic accounting aspects related to the issue of shares. In today's session, we will further discuss the other concepts related to issue of shares. As we have learned about the issue of shares for cash in previous session, now we learn about the issue of shares for consideration other than cash. Sometimes shares are issued to the promoters of the company in lieu of the services provided by them during the incorporation of the company. The issue price of these shares is normally debited to goodwill account and journal entry is made as follows: goodwill account debit to share capital account. Shares can be issued by a company for purchase of assets like building, machinery, stock of material, etc. The following journal entry is made: assets account debit, goodwill account debit to vendor or creditors account to capital reserve account, being assets purchased. Second entry: vendors or creditors account debit to share capital account. Narration is: being number of shares issued of rupees given, each fully paid up. If purchase consideration is more than the net assets acquired, then difference is debited to goodwill account. But if purchase consideration is less than the net asset acquired, the difference is credited to capital reserve account. It may be noted that the vendors or creditors amount would be recorded at the deal price, that is purchase consideration. With this amount in the first entry, vendor or creditor is credited, being giver, and debited in the second entry, being the receiver. On the application of the rule, debit the receiver, credit the giver. If a shareholder pays any amount to the company before it is demanded, it is called call-in advance. This amount is put in a separate account known as call-in advance account. This amount is not shown as capital of the company till such time the company makes a demand from all the shareholders. Call-in advance account is shown on the liability side of the balance sheet. Let us discuss how. If a company issued shares of rupees 10 on which it has already called rupees 5, against the uncalled portion of rupees 5 per share, the company makes a call of rupees 3 per share. The entry for call money due will be made only for rupees 3 per share. Now suppose a shareholder pays rupees 5 per share, including the uncalled amount of rupees 2 per share along with the call money. It means he has paid rupees 2 per share in advance, which will be credited to call-in advance account. The company is required to pay interest on this amount at the rate 12% per annum till the date of its appropriation. Now, we have learned about accounting treatment of call-in advance. Following general entry is made for call-in advance. On receipt of call money in advance, bank account debited to call-in advance account, being calls in advance received on number of shares at the rate given per share. For appropriation of amount received in call-in advance account, journal entry will be call-in advance account debit to share call account, being call-in advance amount adjusted. Let us solve a question on call-in advance. Y Limited received in advance for the first and final call of rupees 2 per share on 1000 shares. The first and final call was due for 10,000 shares after 3 months. Journalize the above transactions and transfer the advance to first and final call account by opening a call in advance account. Solution for the above problem: bank account debited rupees 2000 to call in advance account rupees 2000. Narration being call in advance amount received on 1000 shares at the rate rupees 2 per share. The second entry is share first and final call account debited rupees 20,000 to share capital account rupees 20,000. Narration is being first and final call due on 10,000 equity shares at the rate rupees 2 per share. Call in advance account debited rupees 2,000, bank account debited rupees 18,000 to share first and final call account rupees 20,000. The narration is being first and final call money received on call in advance amount adjusted. Now, the total amount due on second and final call is rupees 10,000 multiplied by 2, that is rupees 20,000, because rupees 2,000 received previously as call in advance. So, at this call maximum amount of call received would be rupees 20,000 minus 2,000, that is rupees 18,000. The next concept is call in arrears. Many a times a shareholder defaults to pay amount due on allotment or call that terms as call in arrears. In other words, when the company sends notice to the shareholders to pay allotment and call money, it has to be paid by them within the specified time period. If it is not paid by any one or more of the shareholders, the unpaid amount becomes arrears due from them. Such arrears are transferred to an account termed as call in arrears account. The following journal entry is made to record call in arrears. Call in arrears account debited to share allotment or call account. Narration is being share allotment or call money not received on number of shares. The second entry, when the unpaid balance is received later on, the following journal entry is made: bank account debited to call in arrears account. The narration is being amount due on allotment or call remaining unpaid now received on number of shares. Let us discuss a case of call in arrears account. Global Limited made the second and final call on its 10,000 shares at rupees 2 per share. The whole of the amount was received except on 1,000 share allotted to Kanika. Pass the necessary journal entries for the call money due and received by opening call in arrears account. The following two entries will be passed. In this case, the first entry will be for amount due, that is share second and final call account debited rupees 20,000 to share capital account rupees 20,000. The narration is being second and final call money due on 10,000 shares at rupees 2 each. The second entry will adjust the amount not being received due to call in arrears. Bank account debited rupees 18,000, calls in arrear account debited rupees 2,000 to share second and final call account rupees 20,000. The narration is being second and final call money received except on 1,000 shares. The bank entry would be on 9,000 shares at the rate rupees 2, that amounts to rupees 18,000. Call in arrear amounts to 1,000 shares at the rate rupees 2, that is rupees 2,000, and share second and final call amounts to rupees 20,000, same as it was made due. Now, let us discuss the next concept of full subscription, under subscription and over subscription. The first is full subscription. The shares are said to be fully subscribed when the number of shares applied for is exactly equals to shares offered for subscription. For example, if a company has offered 10,000 shares to public and public apply for the same number of shares, that is 10,000, it will be termed as a case of full subscription or fully subscribed. The second is under subscription. The issue is said to have been under subscribed when the company receives applications for less number of shares than offered to the public for subscription. The company can proceed with allotment for the subscription made by public. Continuing with the same example, if a company has offered 10,000 shares to the public and the public apply for 9,500 shares, it will be termed as a case of under subscription by rupees 500. It may be noted that the company has to receive a minimum subscription of 90% to issue the shares. Next case is oversubscription. The shares are said to be oversubscribed when the number of shares applied for is more than the shares offered for subscription. With the same example, if a company has offered 10,000 shares to the public and the public apply for 11,000 shares, it will be termed as a case of oversubscription by 1,000 shares. In case of oversubscription, company has the following options. If the application money received on partially accepted applications is more than the amount required for adjustment towards allotment money, the excess money is refunded. However, if the articles of the company so authorize, the directors may retain the excess money as call in advance to be adjusted against the calls falling due later on. Let us discuss the accounting treatment at the time of oversubscription. Option 1. The company may reject the applications for shares and return money in excess of the shares offered for issue, and a letter of rejection is sent to such applicants. In this case, the application money received from these applicants is refunded to them in full. The journal entry made is as follows. Share application account debited to bank account. Narration is being application money on number of shares at the rate given is refunded to the applicants. Above journal entry passed along with entry of transfer of money received on application to share capital, the combined entry will be as follows. Share application account debited with the total amount received to share capital account with the application accepted to bank account with the application rejected. The narration is being application money on number of shares at the rate given refunded to the applicants. The company may go for the option second. If articles of the company authorize, so as we have studied in previous slide, partial acceptance of applications is made. In some cases, the company accepts the application for subscription partially. It means that the company does not allot the full number of shares applied for. For example, if an applicant has applied for 5,000 shares and is allotted only 2,000 shares, then the application is said to have been partially accepted. The company may evolve some formula of accepting applications partially or making proportionate allotment, that is the pro rata allotment, which means that the applicants are allotted shares proportionately. In such a case, the company adjusts the excess shares money received on application towards share allotment money due on partially accepted applications. The journal entry recording the adjustment of application money towards share allotment money is as under. Share application account debited to share allotment account. Narration is being share application money transferred to share allotment account in respect of number of shares at the rate given on applications. That was the topic for today's session. I hope you all have understood it well. Before ending the session, let us have a quick recap of what we have learned today. We have learnt about issue of shares for consideration other than cash. Further, we have discussed about call in advance and call in arrears and their accounting treatment, and the concept of full subscription, under subscription and over subscription. I hope all you have understood today's session very well. With this, we have come to an end of today's session. I hope you have enjoyed it. Thank you very much. Happy learning.